Ever thought about investing but felt overwhelmed by stocks and market jargon? What if there was a simple, smart way to grow your money, even if you're a beginner? That's where mutual funds come in. A mutual fund is like a big investment pot where multiple people contribute money. A professional fund manager then invests this pooled money in stocks, bonds, or other assets. You get a share of the profits based on how much you invest. Simple, right? When you invest in a mutual fund, your money is combined with other investors. The fund manager uses this to buy a diversified mix of assets, reducing risk. As the value of these assets grows, so does your investment. There are different types of mutual funds. Equity funds invest in stocks, higher risk, higher returns. Debt funds invest in bonds, safer, steady returns. Hybrid funds, a mix of both. Choose based on your risk appetite and goals. Why invest in mutual funds? Diversification reduces risk. Expert management, no need to pick stocks yourself. Liquidity, withdraw when needed. Start small, even with just 100. Of course, no investment is risk-free. Market fluctuations, fees, and no guaranteed returns are factors to consider. But with the right strategy, mutual funds can still be a great wealth-building tool. Whether you're a student, a working professional, or planning retirement, mutual funds fit almost every financial goal. The key? Start early, stay consistent. Like this guide? Hit the like button, subscribe, and let us know in the comments what's your biggest question about mutual funds. See you in the next video.